Today I have the pleasure of speaking with Daniel Carlson. He's the CFO for American Sands Energy Corp. How are you today, Daniel?
I'm great, thanks, Tracy. How are you?
I'm great. I enjoyed reading a story this morning of Peter Epstein on how you're the Holy Grail for the oil sand production industry. Can you tell us what he means by that?
Well, I think what Peter's getting at is that we have a very unique opportunity in our cost structure being dramatically different from what's out there in the oil sands industry, and also our environmental impact being much lower. So when you compare us with what's currently in production in oil sands, we are much cheaper on a per barrel basis, much cheaper on a CAPEX basis, and very importantly, we don't use or produce any dirty water in our process. So from an environmental standpoint, we're very benign on a comparison basis.
Well, usually we don't interview CFOs, but I think it's very appropriate in this particular case because any interested shareholder out there is going to be fascinated by how much, by the actual business model that you have for American Sands Energy. So let's just start with the fact you got a $50 million market cap, you're debt-free, which is also very unusual, and you have some kind of proprietary solvent, right, to extract the oil sands. Can you talk to us a little bit about this?
Sure. Regarding the production methodology we have what's called a wet oil sands. So in contrast to what people see in the Canadian oil sands, that's a water wet sand. There is no water in the sandstone that we're processing. It's a mining process. We mine this sandstone that's impregnated with oil. We then take the ground up sandstone and we put it in a solvent solution and just mix it up. And the solvent separates, it basically washes the bitumen off of the sand. At the end of the day, we end up cleaning up our bitumen, removing the solvent from it, and the bitumen is free and clear to go to market, and the sand is clean of bitumen and also clean of solvent, ready to go back in the ground.
Is this why your production timeline is so incredibly fast? I mean, did I read this correct? You might actually be in commercial production by 2016?
Yeah, so we are currently in the permitting process, which we hope to have done by year end, and frankly, we think we're on track to even exceed that timeline. Post-permitting, we do have to raise money to go into production, but we are about 18 months post-permitting, capital markets dependent from being in production. So it is a very rapid timeline. So within 2 years from now, we expect to be producing at 5,000 barrels per day.
Okay, now with this particular extraction process, there was something here that I did not understand, okay? So I was hoping maybe you could educate me and our audience at the same time. It says here with oil sands extraction, there is no decline curve because it's really a mining operation, not an oil drilling play. I thought that seemed relevant to me. Can you explain further to our audience what you mean by that?
Well, sure. I mean, really, when you talk about a decline curve, it's really comparing what we're producing versus what a typical oil well or fracking operation does. Where when you have a basic drilling operation, you stick a hole in the ground, and the oil is pressurized and comes out pretty fast at first, and then suffers a decline. So if you look at some of these fracking operations that take place, they can produce as much as 5,000 barrels a day, and then within 2 years, that might be producing less than 100 barrels per day. We have a mining operation, so our process is going to be producing at the speed that we put ore through the facility. We're going to put 10,000 tons of ore per day through our facility, and we will be producing at 5,000 barrels per day until the bitumen runs out. So there's no decline curve. It gets 5,000 a day until the day we stop operation.
Okay. In the interview with your director, William Champion, what Peter was drawing our attention to, he did ask William about the financing. What kind of size of financing are we looking to in order to get American Sands into production?
So we would need about $75 million to go into production. And then when you back to Peter's comment about the Holy Grail, on a per barrel basis, that's about $15,000. So for each barrel we produce per day, it costs about $15,000 in CAPEX up front. And that's, once again, if you want to compare us with what the Canadian operations are looking at, they run a low of maybe 30,000 to as high as over 100,000 per flowing barrel. So on a comparative basis, it's a very cheap sort of CAPEX. And I'll also say that Peter alluded to in there that there's no additional costs on a going forward basis. So we'll have maintenance costs, et cetera, but once the facility is up and running, we don't have to reinvest in it as a drilling operation would. For instance, if you're producing oil from a traditional drilling operation and you'd have a decline curve, in order to maintain your production, you have to continually source new wells and drill new holes and run the risk of having dry holes. So there's continual CAPEX in the traditional exploration and production model that we don't have.
Well, Daniel, thank you so much for joining us today. We look forward to following this story over the next 12 months.
Great. Thank you, Tracy.